Let me ask you a question. What if I told you that the secret to becoming one of the richest men in the world was actually pretty simple? It's not about taking massive risks or having insider knowledge. In fact, it's about patience, discipline, and the power of compound interest. Today, we're diving into the investment strategies of Warren Buffett and how he built Berkshire Hathaway into a global conglomerate. Welcome to Elite Pathways, the place where future billionaires meet. Before we jump in, don't forget to subscribe, like, and hit the notification bell so you never miss out on the stories of the world's wealthiest and their road to success. Warren Buffett didn't start as a billionaire. His story begins in Omaha, Nebraska, where he showed an early knack for business. At just 11 years old, Buffett made his first stock purchase, buying 3 shares of Citi Service Preferred for $38 each. This early experience laid the foundation for his lifelong interest in investing. In his teenage years, Buffett became obsessed with finance and the stock market, reading books like Benjamin Graham's The Intelligent Investor, which shaped his investing philosophy. Graham's concept of value investing, buying undervalued stocks and holding them for long-term gains, resonated deeply with Buffett. This concept became one of the core pillars of his investment playbook. After studying under Benjamin Graham at Columbia Business School, Buffett worked at his mentor's investment firm before striking out on his own. He eventually came across a struggling textile company called Berkshire Hathaway, and this would become the vehicle for his empire. So what is value investing, and why does it form the backbone of Warren Buffett's strategy? Value investing is simple in theory, but difficult in practice. The idea is to find stocks that are undervalued, companies that are trading for less than their intrinsic value, and hold on to them until the market corrects itself. This requires 2 things: patience and the ability to identify long-term value when others can't. Buffett often says, "Price is what you pay. Value is what you get." He avoids chasing hot stocks or trends and instead focuses on companies with solid fundamentals, those with good management, a competitive advantage, and a strong track record. In many ways, Buffett's investment style is the opposite of high-risk, high-reward strategies. It's about making smart decisions based on facts, not hype. One of the most famous examples of Buffett's value investing approach was his 1965 purchase of Berkshire Hathaway. Originally a textile company, Berkshire was struggling financially. While the textile business eventually failed, Buffett used the company's resources to make other investments, turning it into one of the largest holding companies in the world. Warren Buffett has always been a huge advocate of compound interest, which Albert Einstein once called the 8th wonder of the world. Buffett is often quoted saying, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." So what exactly is compound interest, and why is it so powerful? Simply put, compound interest allows your money to grow exponentially over time. When you reinvest your earnings, you earn interest not just on your initial investment, but on the accumulated interest as well. Over time, this snowball effect can turn a small investment into a massive fortune. Here's how Buffett put this into practice. Instead of cashing out on his investments for short-term gains, Buffett kept reinvesting his profits back into Berkshire Hathaway. By doing so, he allowed compound interest to work its magic. Consider this: Buffett made his first million at the age of 30. But it wasn't until he was 56 that he became a billionaire. This slow build is typical of compound growth. The early years can seem slow, but over decades, the results are staggering. By age 90, Buffett's net worth was over $100 billion, with much of that growth coming in the last 30 years. Another key to Warren Buffett's investment playbook is the concept of the circle of competence. Buffett advises investors to stick to industries and sectors they truly understand. He once said, "You don't have to be an expert on everything, but you do need to understand what you are doing." Buffett's strategy is to stay within his circle of competence, meaning he only invests in businesses and industries he thoroughly understands. This is why Buffett avoided investing in companies like .coms during the 1990s tech bubble. Despite enormous hype, Buffett recognized that he didn't fully understand the rapidly changing tech landscape. By staying disciplined, he avoided major losses when the bubble burst. Instead, he focused on industries like insurance, banking, consumer goods, and energy, where he can easily analyze company fundamentals. His investments in companies like Coca-Cola, American Express, and Apple reflect his belief in buying great companies with staying power, not just those riding temporary trends. If there's one lesson we can learn from Warren Buffett, It's the power of patience. Buffett often says that the stock market is a device for transferring money from the impatient to the patient. He doesn't invest with the goal of making quick gains. Instead, he's willing to wait years or even decades for an investment to fully realize its potential. Buffett's long-term vision is perfectly illustrated in his investment in Coca-Cola. He purchased shares in the beverage company in 1988, during a period when the company was struggling. Over the decades, Coca-Cola's stock price skyrocketed, and the company became one of Buffett's most profitable investments. To this day, Berkshire Hathaway owns more than 400 million shares of Coca-Cola, and Buffett still receives over $600 million in dividends annually from this one investment alone. His long-term perspective also extends to his business ventures. Unlike many CEOs who are driven by quarterly earnings reports, Buffett has often said, "Our favorite holding period is forever." This mindset allows him to ignore short-term market fluctuations and focus on the intrinsic value of his investments. This approach also aligns with his buy and hold strategy, where he focuses on buying great companies at a good price and holding on to them indefinitely. Now let's talk about how Warren Buffett turned Berkshire Hathaway from a struggling textile company into a global conglomerate. His strategy was to use the cash flow from the company's initial operations to make strategic acquisitions in different industries. One of Buffett's most famous acquisitions was GEICO. Buffett had long admired the insurance company for its efficient business model and potential for growth. In 1996, Berkshire Hathaway bought GEICO outright, and it remains one of Buffett's most successful investments. Buffett's ability to spot undervalued companies and make acquisitions is unparalleled. From BNSF Railway to Dairy Queen, he has built Berkshire Hathaway into a company with a diverse portfolio of businesses. Today, Berkshire owns over 60 subsidiaries, including Duracell, NetJets, and Fruit of the Loom. Unlike typical conglomerates, Berkshire Hathaway operates with minimal oversight from Buffett. He famously gives the managers of the companies he acquires a great deal of autonomy, allowing them to run their businesses independently. This trust-based approach has allowed Buffett to focus on big-picture decisions while letting talented managers drive day-to-day operations. Warren Buffett's billionaire playbook is simple but powerful. Value investing, compound interest, staying within your circle of competence, and the willingness to be patient. His long-term vision and disciplined approach have transformed Berkshire Hathaway into one of the largest conglomerates in the world. If you're inspired by Warren Buffett's journey and want to learn more about the strategies of the world's wealthiest entrepreneurs, don't forget to subscribe, like, and hit the notification bell. Here at Elite Pathways, the place where future billionaires meet, we're here to help you take your first step toward becoming the next visionary billionaire. Stay tuned for more insights into the minds and lifestyles of the world's wealthiest and most successful people.